Welcome to this Killick Explains video, and welcome to a piece of jargon which I've covered before, but I think with markets pretty volatile at the moment, it's worth taking another look at. And that piece of jargon is diversification. So what is diversification? Essentially, the core idea is very simple. It's the idea that you don't want to put all your eggs in one basket. In other words, you want to be spreading your wealth over a range of different assets. So at the top level, you have asset allocation, diversification if you like. And that's the idea that you want to put your wealth into different baskets. Equities, fixed income or bonds as they're known, cash, property, alternatives, and so on. And that is the idea that if you spread your wealth across different asset baskets, then as hopefully one suffers, others will compensate. There are a few environments, and we're seeing that at the moment, where everything can get dragged down together, but nonetheless you've got a sort of top level diversification. But then, if you drill down into, let's say, the equity portion of your overall asset allocation, then you want to be doing diversification again within that basket. So what do we mean by that? You want to be diversifying across different themes. Now, I've talked about themes before, but digitization, reshoring as globalization creaks, and so on, are big, sticky themes. They're structural. They're not about to go away. They're not going to be obliterated by what's happening in equity markets at the moment with interest rate rises, inflation, the war in the Ukraine, and so on. So identifying different themes is one way of diversifying. Identifying different styles, that is the idea that there are some types of stock which are cyclical, some which are more defensive. Different sectors, whether you're talking technology, which by the way I certainly wouldn't just abandon because some members of that sector are taking a hit at the moment, all the way through to sort of utilities, if you like. So you're talking about stocks which offer growth rather than dividends or a mixture of the two. You've got geographies. It's the idea of international diversification around different currencies, for example. So as one currency weakens, others strengthen and so on. And then sizes, which I'll come back to in a moment, different sizes of security. Right, so you're thinking, I'm going to diversify. I'm going to do it at the top level across different types of asset. And then within each asset basket, I'm going to diversify at layer 2, if you like. So how many stocks do you need to apply these diversification principles to? Well, I'm afraid there's no simple and right answer to that. The capital asset pricing model, which isn't universally admired and loved, suggests that you get most of the single stock risk eliminated from your portfolio if you have around 20 to 25 stocks. So that's a kind of benchmark, if you like. And that, as I say, is good at dealing with single stock risk, but it's not a hard and fast rule. You will find that some funds hold a lot more stocks than that. Some individual investors, if they think they know what they're doing, may hold fewer. Now, let's say you've done all this, but when can diversification go wrong? Is it a cast iron guarantee you will never suffer any problems? No. So market risk isn't covered, for example. That's the idea that occasionally the whole market can suffer a short-term hit. We saw that at the start of the pandemic, for example. We've seen it again as Russia launched its war against Ukraine. So occasionally everything is dragged down together, and spreading your risk doesn't cover you against that particular risk. But your attitude to the market is what's going to offer you the protection there. There's over-concentration. Now, over-concentration can happen accidentally. So you've got a portfolio of stocks, and you think, I've done what you said, Tim. I've spread over different themes, styles, geographies, sectors, sizes, and so on. But actually, you haven't checked what's in your pension, for example. You haven't checked the fact that you've got an employee share scheme at work. So suddenly, you've actually got a big exposure to one company or a few companies that essentially you hadn't worked out you had. So watch out for that one. It can be expensive, I accept that. Putting your eggs into different baskets yeah, is going to cost a bit more potentially than just lumping them into one. And you've got to rebalance to fully benefit. Now, what I mean by that is very, very crudely, you might put £100 into the equity market 2020, 20, 20, 20. All right, but one of those 20s suddenly doubles in value, if you like, and that's great in one sense, but suddenly you've got an exposure somewhere in your portfolio which is out of kilter with the rest of it, particularly if you're trying to achieve a kind of even allocation across a number of different baskets. So rebalancing is simply the idea that you might trim a large holding in order to push up one of your other baskets, if you like. Okay, so there's a very quick tour of what diversification is, what it can do, and what it sometimes can't do for you. If you'd like to know more about what is a pretty big topic, and there are lots of topics related to it, then I've got a comprehensive video library, killick.com/learn, and on this side you'll find a shares tab, could be a good place to start. If you'd like to read about some of this stuff, the themes I mentioned, the styles, the sectors, in a bit more detail, in sort of context, if you like, from some experts, rather than from Mr. Education sitting on this stool, then Confidant, our quarterly magazine, is not a bad place to start looking. And if you'd just like to know in general terms at your leisure a bit more about equity investing, then we do have a guide, a how-to guide called How to Invest in Equities. And for Confidant and the guide, it would be, just to remind you, editor@killick.com.